What happens when the systems we've trusted for decades starts to lose its grip right in front of our eyes? We're not just watching another cycle of volatility. This is different. Beneath the headlines, beneath the charts, something much deeper is breaking. Confidence. Not the kind you measure with a sentiment index, but real structural confidence. The belief that governments can manage trade, that central banks can steer the economy, that someone, anyone, is in control. The belief, it's fading fast. The cracks are no longer beneath the surface. They're out in the open. This week, Trump reignited the trade war with a staggering 145% tariff on China. Markets shook, recession fears surged, and amid all of it, one asset quietly moved in the opposite direction. Bitcoin. People can feel it, even if they can't explain it. The old system isn't working like it used to, and deep down, everyone is wondering the same thing. What replaces it when it finally breaks? Let's break down what's really going on and why Bitcoin may be the answer as the rest of the system unravels. See, back in the year 2000, the United States was the undisputed heavyweight champion of global trade. Its total trade volume dwarfed China. Most of the world was doing business with the US first. But fast forward to today, and that map has flipped literally. According to new trade data, China has surpassed the US as the largest trading partner for the majority of the countries worldwide. In 2000, US trade stood at $2 trillion, and China, just $474 billion. But by 2024, the tables turned. The US trade grew to $5.3 trillion, but China skyrocketed to $6.2 trillion. The global map, once a sea of American blue, is now covered in Chinese red. Europe, Asia, Africa, South America, all trading more with China than the US. And it's not just a statistic. It's a warning. America's economic dominance has eroded. The geoeconomic center of gravity is shifting to the east. But the US is not going quietly. In response to what he called China's ongoing disrespect toward global markets, Trump didn't just raise tariffs, he dropped the economic equivalent of a nuclear bomb, a 125% tariff on Chinese goods. And just when the markets were trying to digest the headline, the White House clarified the real figure was 145% after accounting for previously implemented rates. That's not a trade policy tweak. That's an open declaration of economic war. But Trump didn't stop there. For over 75 countries that had not retaliated against the US trade policy, he offered a 90-day pause and a 10% base tariff temporarily, giving them a chance to negotiate. It was a bold move, and it started producing results almost immediately. Canada quickly responded, offering to drop its own tariffs if Trump did the same. The European Union began seriously considering a pause on its planned countermeasures, which were set to take effect just days later. Nations weren't just reacting, they were repositioning. Trump had reshaped the negotiation table, and no one wanted to be left out. And while all of this was unfolding, Trump signaled he's open to direct talks with Chinese President Xi Jinping, offering to meet and negotiate. As of now, no official meetings have been scheduled, but the invitation is on the table. But the uncertainty, it's lingering. The markets didn't know how to react. When Trump announced a surprise 90-day pause on tariffs for non-retaliating countries, stocks and crypto exploded higher. God candle. The S&P rallied nearly 10%, posting one of the strongest single-day moves in years. It was a kind of a relief rally that screamed, maybe this won't spiral after all. But the optimism, it didn't last. Within 24 hours, markets reversed, the Dow plunged 1,300 points, and NASDAQ dropped 4%. The S&P 500, well, it fell 3%. Many of the gains were given back. It was a classic whipsaw, confusion, volatility, and no clear direction. Here is what Trump had to say.
Can you give us a reaction to today's stock market drop and also give us a sense of the next steps with China?
Well, I haven't seen it because I've been here for 2.5 hours, so...
He just wrapped up a 2.5-hour press conference, seemingly unmoved. Treasury Secretary Scott Bessent stepped in with reassurance, but not retreat.
The up 2, down 1 is not a bad ratio, or up 10, down 5.
In their eyes, the short-term chaos was expected and maybe even necessary. Bessent framed it as part of the broader strategy: pressure countries into coming to the table over the next 90 days. And if that meant some turbulence in the meantime, well, so be it. The message to markets was clear: don't mistake volatility for weakness. This is by design. With markets turning sharply, it's starting to feel like investors have priced in Trump playing his final card. The so-called Trump put may be in full effect. His 90-day pause could be seen as him finally caving to the pain of falling markets. But now, the spotlight is shifting. All eyes are on the Fed. According to the Kansas City Fed President Jeff Schmidt, the central bank is now watching markets minute by minute to ensure liquidity keeps flowing. Minute by minute? That's not what you do when the system is healthy. That's what an ER doctor does watching a patient whose condition could turn at any moment. Trump may have flipped the board with his tariff barrage and strategic pause, but now Powell's the one left holding the financial system together. And the big question is whether he's ready to step in with rate cuts if things get worse. Right now, the answer looks like no, unfortunately. For a brief moment, markets thought they had something to celebrate. The latest CPI report came in softer than expected. Headline inflation actually declined on the month, and core inflation rose just 0.1%, well below forecasts. Traders jumped on the data, hoping it would fast-track Fed rate cuts and cool recession fears. But that optimism was built on a backward-looping report. The CPI data was collected before Trump dropped his 145% tariff bombshell on China. And while the numbers looked encouraging on paper, key voices were already warning that it wouldn't last. But we already know, China may be different, and that's a lot of goods that come in, but we know overall inflation has been lower. We've been talking about it on this channel forever. Amazon came out early in the day confirming what most smart investors already feared. The real inflation could still be coming. The company revealed that it had made strategic forward inventory purchase to soften the impact of expected tariff hikes, but made it clear that cost will be passed to consumers later.
I'm guessing that sellers will pass that cost on.
Fully.
I think they'll try, and I understand why. I mean, depending on which country you're in, you don't have 50% extra margin that you can play with. So I think they'll try and pass the cost on. And as I said, it's so early right now, but we haven't seen any change in consumer behavior in a meaningful way yet.
That announcement added fuel to the fire, helping drive negative sentiment in the market throughout the day. And they're not alone. Atlanta Fed President Tom Barkin warned that inflationary effects from the tariffs likely would show up until June, once businesses work through existing inventory. In other words, the CPI dip we saw wasn't a turning point. It was just a delay. As if the markets didn't have enough to process with trade wars and inflation traps and political headlines only added to the chaos. Just as investors were trying to digest the 145% tariff shock and new inflation data, Senator Elizabeth Warren called for investigation into whether President Trump manipulated the markets to benefit Wall Street insiders. Which is rich, coming from someone who once manipulated her way into the Harvard faculty by claiming to be American Indian. Yep. The hypocrisy is everywhere. Next thing you know, she'll say Bitcoin is cultural appropriation. Her claim? The tariff flip-flopping may have been strategically timed to help major donors profit, especially those with exposure to short-term volatility. Whether or not there's proof, the accusation alone added another layer of political risk to an already fragile sentiment. And then came the headlines that Trump was trying to fire Fed Chair Jerome Powell, a move that would spark institutional panic if true. But digging deeper, here's what really happened. Trump asked the Supreme Court to clarify whether a president has the authority to fire the heads of independent agencies. Powell's name was never mentioned, but he clearly could be impacted. Tell me if I'm allowed to fire Powell without telling me I'm allowed to fire Powell, is basically what happened. Even without official action, the implications are massive. Markets are already uncertain. And now they're watching Washington for power plays, legal fights, and potential Fed shakeups. The results? Less clarity, more volatility. This isn't just a trade war. It's a political minefield. And every new headline makes it harder for markets to find stable footing. While the market focuses on tariffs and inflation, a quieter but equally important shift is happening behind the scenes. The regulatory environment around crypto is flipping. The old guard, defined by friction, lawsuits, and unclear rules, is slowly but surely being replaced. The Senate just confirmed Paul Atkins as a new chair of the SEC, filling the seat left by the dreaded Gary Gensler. A name synonymous with crypto crackdowns, regulation by enforcement, and Atkins is no crypto anarchist, but he represents a meaningful pivot. His background is rooted in pro-market, light touch regulation, and less hostility toward digital assets. But this shift isn't just happening inside regulatory agencies. It's now happening in Congress and the White House. In a landmark move, President Trump just signed a resolution striking down an IRS rule targeting DeFi platforms. Big win. That rule, originally approved during the final days of the Biden administration to try to take us out, would have forced decentralized projects to report user activity like traditional brokers. They obviously didn't understand DeFi. It's now officially dead. And it's the first time a pro-crypto initiative has successfully cleared Congress and been signed into law. Not just an executive order, passed Congress into law. Big deal. The vote wasn't close either. Both chambers of Congress passed the resolution with strong bipartisan support, signaling that crypto isn't just gaining ground in the private sector, but it's gaining ground, importantly, in Washington. The implications are huge. Lawmakers are now pushing forward on stablecoin regulation and market structure bills, the laws and rules and regulations in which us builders are allowed to operate. And the White House has already signaled it wants a comprehensive crypto framework on the president's desk by August. Crypto doesn't need handholding, but it does need regulatory certainty. And with both Congress and regulators starting to flip, that certainty is finally within reach. And while Washington is finally starting to catch up, not everyone is convinced the system can be saved. Some say that problems run much deeper than regulation or tax policy. They say we're headed to a full-blown reset. Ray Dalio, one of the most respected investors of our time, isn't holding back his words. He said this isn't a normal recession. It's a start of a new monetary order away from the US dollar dominance.
We are changing the monetary order. In other words, when we start to think there's supply and the demand for debt, and one man's debts are another man's assets, as I said. And then the question is, money, which is debt, is supposed to be both a medium of exchange and a storehold of wealth. And there are times in history, and this is one of those times in history, that there's a question of whether bonds are an effective storehold of wealth because of this supply, demand, and so on.
Fed advisor Kevin Hassett echoed the growing concern. revealing that the bond market came dangerously close to causing a panic behind the scenes. The issue wasn't just about price action. It was about credibility, which is everything for the US bond market. The Treasury market is supposed to be the deepest, most stable pool of capital in the world, hands down, flat out. When that starts to wobble, it sends shockwaves through everything else, from mortgages and corporate debt to equities and currencies. And here's the problem for the Fed. They can't let the market break. If yields spike too fast, the cost of servicing debt skyrockets, the financial system tightens, and the risk of credit crunches rise. But if the Fed steps in to contain it through rate cuts, bond buying, or yield curve control, they risk reigniting inflation or signaling that they've lost control of the narrative. It's a lose-lose scenario. Support the bond market and look weak, or do nothing and risk systemic instability. That's why the Fed is stuck. Policy decisions going forward aren't about economic data anymore. They're about managing fragility, maintaining appearance, and buying time. If you're waiting for a signal that the Fed's margin for error is gone, this is it. As the dust from Trump's tariff escalation settles, one narrative is rising above the noise. The risk of a recession is growing fast. According to Polymarket, the probability of a US recession is now back at 60%. And this isn't just traders reacting to headlines. It's the accumulation of months of pressure building across inflation, trade, credit markets, and consumer sentiment. The latest wave of tariffs, especially the staggering 145% on China, sent shockwaves through global supply chains. Think about it for a second. How many things around your house say made in China on the bottom? At first, I tried to think about it and think it wasn't a big deal, but it's everything. Now imagine what happens when all of those get hit with a 145% cost spike. As input costs rise and cross-border uncertainty climbs, businesses are hitting the brakes on hiring, delaying investments, and raising prices downstream. That's not just inflationary, it's economically destabilizing. And while some investors are hoping for a political pivot, well, it's not guaranteed. Trump has offered to meet with President Xi Jinping to negotiate. If a deal comes, markets could absolutely explode higher. But no official meetings have been scheduled, and Beijing hasn't responded publicly to the offer. As investor Joe McCann put it, if a China deal comes, the market explodes. If it doesn't, it's already priced in. Right now, Bitcoin and crypto are sitting in a powerful position with two potential catalysts on the horizon. First, if Trump and China announce negotiations or strike a deal, risk assets across the board could rally. Markets are already bracing for uncertainty, so any breakthrough would likely send prices surging, meaning that the uncertainty is priced in right now. Probably can't get too much worse. It could, but like not too much, right? And crypto as a high beta asset class would move very fast if we get some positive news. Second, if things break down instead, if a recession risk spikes, markets crack, and liquidity dries up, the Fed will be forced to step in, whether through rate cuts, quantitative easing, or even emergency backstops. Any major policy response becomes fuel for Bitcoin. Every move to patch a system only reinforces the case for something outside of it. So ask yourself, are you positioned for either outcome? Because Bitcoin is. If this video, my friends, helped you see the bigger picture, do me a favor, please hit that like button. Share this video with one of your loved ones if you think that they could benefit from it. And make sure they subscribe to the channel if you're not already. Drop a comment, let me know your thoughts as well. Deal or disaster, which one hits first? And make sure you're subscribed because I'll be breaking it all down week by week as this story unfolds. Until next time, ladies and gentlemen, stay sharp and stack sats.